Solana, this is pretty obvious.
Yeah.
To me, it's just, knowing what we know about the macro, looking at those charts, looking at like Ethereum. I mean, these are nice charts.
Yeah, they show ranging for a period of time, which we realize in crypto you just have to have insane patience.
Caution has largely dominated the cryptocurrency market, especially following the sharp drop on October 11th. The impact of this drop is gradually dissipating, and market sentiment, far from deteriorating, appears to have regained optimism. Since the end of the month, signs of recovery have emerged. Net capital inflows are positive, altcoin ETFs have been approved in batches, and expectations of interest rate cuts are strengthening. The Bitcoin spot ETF recorded a cumulative net inflow of $4.21 billion this month, completely reversing the $1.23 billion outflow seen in September. Assets under management reached $178.2 billion, representing 6.8% of Bitcoin's total market capitalization. From October 20 to 27 alone, there was an inflow of $446 million in new capital, including $324 million into BlackRock's IBIT fund. Cryptocurrency holdings now exceed 800,000 Bitcoin. According to the latest data, the average allocation of crypto assets by institutions has reached a record 5%. According to Raoul Pal, Solana is nowhere near the top. We are about to explode. Before we move forward, if you want to stay updated with the latest crypto events and news, you can subscribe to our channel and like this video. Now let's get back to Raoul Pal's view on Solana and the overall crypto market.
Total 3, so that's excluding Bitcoin and ETH.
Yeah.
Right, so we still haven't gone through where we were peak of the prior cycle. And it's been a slow crawl versus a speedy ramp. And this is because I think it's to do with the debt maturity got extended. So this is like a weird mid-year. I thought in July it was going to break through. Not that I'd do anything about it. And then it had the big puke. But really, a pattern like this usually means that we will eventually have what we want. But it's the patience that's tested everybody. Because this has been a long period where a lot of this stuff has not gone to highs. And even then, it was January that everything else was at its highs, like SUI and everything else. And so everyone's been waiting 11 months or 10 months to have anything.
Yeah, look, honestly, I kind of feel like January, in a traditional sense, may have been felt like a top. If it wasn't for the ETF just kind of making sure that there was a continual bid for let's say Bitcoin, ETH, Solana, that felt like if you go back to what previous tops felt like, it was like, we are everything's about to go 100x. You didn't want to hold any stables because everything was just going up so much higher. And then we've gone through this period of just sideways or downward price action. Now people are calling for the top, and I'm like, this just doesn't feel like a top.
I've seen entire hedge funds in the crypto space, because I've got the asset management business that invests in crypto hedge funds, rewriting their mandates to trade equities. And I'm this is a signal, generally speaking. And, when you say, well, why have equities done better? What's going on? Why is crypto underperformed? Why is gold outperformed? It's all based down onto the same everything code framework. So gold is currently gold used to be real rates. That used to be what gold traded on for a long period of time. It's now current financial conditions. Financial conditions lead by about 6 months Bitcoin. So when you put those up, share the chart on X, it's like a perfect match. Is it going to match perfectly in the end? Who knows? But basically, it's living in the future gold or living in present financial conditions. Equities have been living in liquidity, as have crypto. But since the Fed shutdown and the draining of the reverse repo, there's been issues in the plumbing of the financial system. So liquidity has been drained out.
Raoul Pal's 5-year cycle theory represents a fundamental reinterpretation of the traditional 4-year Bitcoin halving cycle. According to him, this traditional cycle is not determined by the Bitcoin protocol itself, but rather results from the coincidence of the last 3 cycles, 2009 to 2013, 2013 to 2017, 2017 to 2021, with the global debt refinancing cycle. The key to this theoretical shift lies in the structural evolution of the average maturity of U.S. debt between 2021 and 2022. In a context of near zero interest rates, the U.S. Treasury extended the weighted average maturity of its debt from approximately 4 years to 5.4 years. This extension has not only affected the debt refinancing schedule, but more importantly, has altered the pace of global liquidity injections, delaying Bitcoin's cyclical peak from the fourth quarter of 2025 to the second quarter of 2026. This also suggests a market recovery in the fourth quarter of 2025. According to Raoul Pal, total global debt has reached approximately $300 trillion, of which nearly $10 trillion is nearing maturity. In the cryptocurrency sector, a $10 trillion refinancing could inject $2 to $3 trillion into risky assets, driving Bitcoin's price from its $60,000 low in 2024 to over $200,000 in 2026. Consequently, Paul's model predicts an unprecedented surge in liquidity in the second quarter of 2026. When the ISM index surpasses 60, Bitcoin's entry into the banana zone will be triggered, with a price target of between $200,000 and $450,000. Bitcoin's price fell after the U.S. Treasury General Account (TGA) balance increased to $965 billion, reaching liquidity in the markets. Bitcoin typically reacts quickly to changes in liquidity. Amid these tensions, its price has failed to break through the established threshold. However, market analysts believe the situation could improve after the end of the month. Once the adjustments to bank balance sheets are complete, the reverse repurchase program could be unwound, returning approximately $20 billion to the market. If the utility shutdown ends in mid-November, Treasury spending would also increase, injecting more liquidity into the system. Analysts predict this will boost bank reserves and alleviate the slight funding tensions observed in recent weeks. According to the analysis, all these changes could help Bitcoin overcome its current volatility. Furthermore, the return of liquidity could stimulate demand for higher risk assets, leading to improved performance in December. Analyst Satoshi Musk shares a similar perspective, estimating that the U.S. Treasury's general account could reach approximately $950 billion by early November. He predicts that following the reopening of government services, between $500 billion and $1 trillion could be injected back into the markets as the Treasury pays its bills and resumes spending. He notes that previous dips in the general account have had a significant impact on Bitcoin. When the account decreased by $50 billion in 2018, Bitcoin rose by 19%. In 2022, an $80 billion drop boosted its price by 22%. Based on this trend, a much larger liquidity injection could propel Bitcoin up as much as 38%, reaching $152,000. However, market participants believe that the coming weeks will be crucial in determining the impact of the Treasury's decisions and the end of quantitative tightening on the future price evolution of Bitcoin.